to get a problem on marginal costing, please arrange the details from the question in this format. Write on a per unit basis. Now, S stands for sales, V stands for variable cost. Sales minus variable cost gives you contribution, and contribution minus fixed cost gives you profit. So as I said, write in a per unit basis means here you have to write the selling price per unit, and here you have to write the variable cost per unit, and this is the contribution per unit. And fixed cost, please write the total amount, because fixed cost, even if you are selling 1 unit or 100 units, the fixed cost remains the same. So that is why you have to write the total amount of fixed cost. And if in the question fixed cost per unit is given, please multiply it with the budgeted quantity to arrive at the total fixed cost. And profit, you can just leave it as blank, because in the question you will not be asked to find out the profit for 1 unit. And please don't write the elaborations for all this in the scratch pads. Scratch pads does not carry any marks. So in order to make you faster, I want you to write abbreviations for all these so that you can get the work done in no time. Now let's move on to the question. Question number 21. Budgeted details of two products. So you've got P1 and P2 as the two products. Selling price given, direct material given, direct labor given, variable overheads given, fixed overheads given, and profit per unit is also given. Budgeted production and sales for the year ended for product P1, it's 10,000 units, and product P2, it's 12,500 units. I said that whenever you want to convert the fixed overheads, which is given on a per unit basis, to the total fixed cost, then you have to multiply it with the budgeted quantity. Fixed overheads included in P1 relate to apportionment of general overheads only. However, P2 also includes specific fixed overheads totaling 2,500. What do you mean by specific fixed overheads? It means that these fixed overheads are related to P2 alone, which means that if we stop producing P2, then this 2,500 will not be incurred. But as for general overheads, even if you stop producing P2, we will still incur the general overheads. So that's the difference between general overheads and specific fixed overheads. Now, if only product P1 were to be made, so only P1 is to be made, we are not going to produce P2. How many units to the nearest unit would need to be sold in order to achieve a profit of 60,000? So I said that fixed cost is always based on budgeted quantity. So we will arrive at the total fixed cost for P1 and P2. Total fixed cost for P1 is 1.2 per unit multiplied by 10,000 units, which is the budgeted quantity of P1, and the amount works out to $12,000. And as for P2, it is $1 per unit multiplied by 12,500 units, which is a budgeted quantity of P2. So we get the answer as $12,500. Specific fixed overheads of P2 is 2,500. So if P2 is not produced, we will just not incur that amount. So we will reduce the specific fixed overheads of 2,500. So the balance is $12,000 for P1 and $10,000 for P2. So the fixed overheads, if only P1 is made, is $22,000. That is $12,000 plus $10,000, because this is the general overheads. Now with this information of the total fixed overheads, we will complete the basic format that I stated earlier. So for P1, the selling price is $10 per unit, and variable cost, you have got three items here: direct material cost, direct labor cost, and variable overheads. So the total of all this is $5.6. So the contribution is 10 minus 5.6 or $4.4 per unit, and fixed cost $22,000. Now, with this information in hand, it is very easy to tackle any type of marginal costing problem. How many units need to be sold in order to achieve a profit of $60,000? Now we will copy the formula here. The sales required to earn a target profit in units. Since they have asked in units, That's what I have copied here. It is fixed cost plus required profit divided by contribution per unit. Fixed cost, we know it is 22,000. Required profit from the question, it's stated it's $60,000. And contribution per unit, we know it is 4.4. So the sales required to earn a target profit is 18,636 units. Now let's move on to question number 22. Variable cost per unit is $36. The C/S ratio or the contribution to sales ratio is 25%. What is the selling price and the contribution? So we will copy the basic format. What has been given? In the question, the variable cost per unit is given as 36. So we copy that into the format. And the C/S ratio is also given 25%. Now, if the C/S ratio is 25%, what is C/S ratio? It is contribution divided by sales. If contribution divided by sales is 25%, then definitely the variable cost divided by sales ratio will be 75% because both these should add up to 100, which is the sales figure. So what is the selling price? Variable cost is 36, which is equivalent to 75. So 36 divided by 75 multiplied by 100 because sales is equal to 100. So what is the selling price? It is $48. And what is the contribution? It is 48 minus 36 or $12. Now moving to the next question. So here a graph is shown. Now what is this graph? This is nothing but the break-even chart. So let's identify the lines that have been drawn. The line which is parallel to the x-axis. That is nothing but the fixed cost curve. Why? Because irrespective of the number of units sold, the fixed cost remains constant. That is why it's a line which is parallel to the x-axis. Now the line starting from the fixed cost is the total cost curve. Now the total cost curve will always start from the fixed cost point because total cost is actually equal to the fixed cost plus the variable cost. So when the unit sold is 0, the variable cost is 0 and fixed cost, definitely it's a constant figure, so that's 30,000. So 30,000 plus 0. So the total cost when the unit sold is 0 is 30,000. That is why the total cost curve starts from the fixed cost point. And when the units increases, the firm starts to incur variable cost. That is why the total cost curve is upward sloping as the units increases. Now this difference, that is the difference between the total cost and the fixed cost, is nothing but the variable cost. Curve that starts from the origin and curves upwards is the sales curve. Now there is one more line that could be shown in a graph, and that's the variable cost curve. Please note that variable cost curve will run parallel to the total cost curve because the difference between the total cost and the variable cost is the fixed cost, which is constant. That is why the variable cost, if at all it is shown in the graph, will run parallel to the total cost curve. This is just for your information. So right now 3 curves are shown: the fixed cost, the total cost and the sales curve. Now they have asked which statements are correct. The product selling price is $10 per unit. So they have a marking here on the x-axis 10,000 units. So we extend it up till the sales curve and then we join it to the y-axis as well. So when the units is 10,000 units, the sales value is 100,000. So what is the selling price? Selling price is 100,000 divided by 10,000 units. 100,000 is coming from here, which is the sales value, and units 10,000 is coming from here, which means that the selling price is $10 per unit. The first statement is right. Moving to the second statement, the product's variable cost is $8 per unit. Now variable cost is the difference between the total cost and the fixed cost. So when the units were 10,000, what is the total cost? The total cost is $80,000. And what is the fixed cost? Fixed cost is $30,000, which means that variable cost at that point, that is at 10,000 units point, it is $50,000. That is 80,000 minus 30,000. So what is the variable cost per unit? It is $50,000, which is the total variable cost, divided by number of units, which is 10,000 units. So variable cost per unit is $5 per unit. They have said the variable cost is $8 per unit, which is wrong. Now moving to the third statement, the product incurs fixed cost of $30,000 per period. That is true. The fixed cost is $30,000. So that is the right statement. For the fourth statement, the product earns a profit of $70,000 at a level of 10,000 units. Now, profit is sales minus total cost. So at 10,000 level, what is the sales? Sales is 100,000. And what is the total cost? Total cost is 80,000. So profit is sales minus total cost. So you get a profit of $20,000. They have said that the profit earned is $70,000 at a level of 10,000 units. But we found that it is just $20,000, which means that this statement is false. The correct statements are statement 1 and statement 3. And the wrong statements are statement 2 and statement 4. Now moving to the next question. Now, when there are multi-products, that is more than one product is sold, the formulas are more or less similar to the single product formulas, except that for break-even point in units, in single product it was contribution per unit, but for multi-product it is weighted average contribution per unit. And as for break-even point in value, for single product it was C by S ratio, but for multi-product it is weighted average C by S ratio. So the only difference between the single product formula and the multi-product formula is the addition of weighted average to the denominator. Now the question is, how do we calculate the weighted average contribution per unit and weighted average C by S ratio? Weighted average contribution per unit is sum of each product's contribution multiplied by the sales units mix percentage. The next problem is regarding the application of this formula, so you will understand it better after the problem is done. Now, weighted average C by S ratio is total contribution divided by total sales. That is, you're taking the total contribution of all the products and you're dividing it by the total sales of all the products. Now let's start with the next question. Twice as many units of product Y are made and sold as that of product X. Product X contribution per unit is $10 and product Y's contribution per unit is $4. Fixed costs are $90,000. What is the total number of units which must be made and sold to make a profit of $45,000? So we will copy the formula. Sales required to earn a target profit in units. It's fixed cost plus required profit in the numerator, and you have the weighted average contribution per unit in the denominator. Now here the sales units mix. That is, how many units of product X are sold in comparison to product Y is given in the first sentence. Twice as many units of product Y are made and sold as that of product X. It means that you are selling 2 units of product Y for every 1 unit of product X. So the sales units mix ratio is 1:2. Now we will calculate the weighted average contribution per unit. It is a sum of each product's contribution multiplied by the sales units mix percentage. So as for X, the contribution is $10 and the sales units mix percentage for X is 1 out of 3 because 1/3 is for X and 2/3 is for Y. So that is why 10 into 1/3 for X and 4 is the contribution of Y multiplied by 2/3. This is how you calculate the weighted average contribution per unit. So the answer works out to $6 per unit. Now we will substitute $6 per unit in this formula. So fixed cost is $90,000 given in the question. Required profit is $45,000 and weighted average contribution is 6. So the right answer is option B. Just for your understanding, the number of units of X which is to be sold is 22,500 into 1 by third, because the sales units mix percentage is 1/3 for X and 2/3 is for Y. So the units of X is 7,500 units, that is 22,500 into 1 by 3. And as for Y, it is 22,500 into 2 by 3 or 15,000 units. So in case a question asks you what is a unit of X and Y which is to be sold, then the answer is 7,500 and 15,000 units to generate a profit of $45,000. Now moving to the next question. B Limited is changing its structure. Employees are currently paid a fixed salary of $240,000 per annum, but would be paid $200 per working day. Staff produces 40 units per day. So they are actually making an attempt to convert this fixed cost to a variable cost. Because when you're linking it to the number of units, then basically you are creating a variable cost. Other fixed costs are $400,000 per annum. Selling price is 60 and material cost 20. Impact on break-even point and the operating risk. Operating risk, we are running a heavy risk when the proportion of fixed overheads is high, or the operating risk will reduce once the fixed cost reduces. So anyway, we will start with the calculation of the break-even point. Now the direct labor cost calculated on a per unit basis. If you see here, $200 is for every working day. And for each day, 40 units are produced. So what is the direct labor cost per unit? It is $200. That is the labor cost paid per day divided by number of units, which is 40, which is the number of units produced per day. So on a per unit basis, the direct labor cost works out to $5 per unit. Now we will copy the basic format, that is sales minus variable cost per unit gives contribution minus total fixed cost gives you profit. So what is the present scenario? Present scenario, the selling price is $60. Direct material cost is $20. Presently only material cost is variable. The direct labor cost is a fixed cost. The contribution works out to 60 minus 20 or $40. And fixed cost, presently you are paying 240,000 direct labor, and they have also said that other fixed cost is 400,000. So the total fixed cost is 240,000 plus 400,000 or 640,000. This is the present situation. Now, when you change the structure and when you pay it for every working day, and for each working day it's 40 units production, then the direct labor cost per unit works out to $5. The revised situation is the selling price doesn't change, it's $60. The variable cost, earlier it was $20, and to it you have to add the $5 addition of the direct labor cost. So that's why it's $25 in the revised structure. So the contribution is 60 minus 25 or $35. And for the fixed cost, you have only the other fixed cost 400,000. You do not have this fixed salary of direct labor. Now, what was the formula for break-even point? It is fixed cost divided by contribution per unit. So under the present scenario, the fixed cost is 640,000 and contribution per unit is $40. So the break-even point is 16,000 units. And in the revised structure, the fixed cost is 400,000 and the contribution per unit is 35. So the revised break-even point is 11,429 units, which means that there is a reduction to the tune of 4,571 units. Now coming to the operating risk. So they have asked you about the operating gearing ratio, whether it will go down or whether it will go up. As a formula, if you have to write, it measures the proportion of fixed cost in the total cost. So what is the proposed change that is going to be implemented? That is, fixed cost will reduce and it is getting converted to a variable cost portion.
So whenever fixed cost reduces, that is when the numerator reduces, the operating gearing ratio will also reduce. So the right answer is option B, where there is a reduction of 4,571 units in the break-even point. See, from 16,000 units, it has dropped to 11,429 units. And as the fixed cost reduced, the operating gearing ratio also reduces.